Everybody, welcome back to the channel. You are talking to the Stock Brother. I am Jeremy, and you're on the Stock Brother channel. So, welcome back today. Thank you all for stopping in, taking some time to take a look at the video here that I put together. I appreciate all the likes, all the subscribers, and everyone who watches the videos and shares the videos. Thank you very much. It's helping the channel out greatly. So, thank y'all for that. Today, what we're going to do is we're going to get back into the What Is series. This is a series of short videos that I put together in order for you to get to the information that you're trying to get to without having to sift through a bunch of different timestamps and different things like that in order to get to the information you want. So I created this series so you can get exactly to what you want here. So today on the What Is series, we're going to be talking about what is a stock split. There's a lot of different companies that are splitting their stocks right now, and a lot of people don't necessarily have the proper information when it comes to these stock splits and what a stock split actually is. So this video here, hopefully it'll simplify it and give you a better understanding of what a stock split is. So you all keep in mind, I am not a financial advisor. I am here to entertain, educate, and just inform you about the stock market and different things in the stock market to help you in the stock market. So you all keep that in mind, and let's get into this. So what is a stock split? So a stock split basically is going to be a company trying to make their shares cheaper. Or the company is trying to make their shares more affordable for the shareholders. If a company has a stock price of $400 or $500 a share, most people cannot, especially before fractional shares, you could not go and buy that share on a regular basis. The average person just didn't have $400 or $500 to spend on a stock. So what a company will do is to make their stock price look more attractive to shareholders, they will do a stock split. So, for example, if your shares were $400 before and you do a 4-to-1 stock split, that basically means that your shares are not going to look like they're $400 anymore. They're going to look like they're $100 a piece. Now, this doesn't change the value of the company at all. The same, it's almost like turning a dollar into 4 quarters. Either way, it's still a dollar. One just looks like there's 4 of them, and the other just looks like there's 1. So it just looks different, but really and truly, they're both a dollar, no matter how you look at it. It's the same way with a stock split. There might have been one share that you had that was $400, and now you have 4 shares that are $100. So, but for the most part, the value of your shares are still $400. So that's what a stock split is for the most part. It's just a company making their shares more affordable and making them look better to the shareholder, more attractive to the shareholder for them to buy and hold. So when you talk about a reverse split, this is basically going to be the opposite. This happens when a company is basically trying to combine their shares to raise a company's stock price. A lot of times this happens, and you kind of have to be aware of this. A regular stock split is a decent thing. But when you talk about a reverse stock split, you have to look into the reasons why a company will do a reverse stock split. A lot of times when you have companies and their stock price has slid down into a penny stock range, it may have been $15, $20, $30, $40 at one time, but now it's slid all the way down to $2 or $1 and some change for the stock, which is basically considered a penny stock. Well, there are different rules on the different exchanges when you talk about the NASDAQ, the New York Stock Exchange. All of these exchanges have certain rules in order for you to be in compliance in order to be on their exchange. So in order to be traded on the NASDAQ, your stock has to stay over $1. If it trades below $1, they can kick you off or delist you off of the NASDAQ. I think it's about the same when you talk about the New York Stock Exchange. These companies, if their stocks go too low and they stay too low for too long, which is most of the time it's under $1, then they will have to do a reverse stock split. which is basically the reason why they will combine shares in order to make the share price greater, because they don't want to get delisted if the shares are under $1, and they do a reverse split, 4-to-1 reverse split. So now the shares that you had that was $1 is now $4 and some change. So it puts them in compliance when it comes to the exchange that they're on. And it also makes it look a little bit better. A lot of people see that one day and see that the stock price was $1 or less than $1. And then they look again today and see, oh, it's $4. But don't realize that there was a reverse split that happened. They just think the stock went up. Again, it attracts some shareholders who don't necessarily know exactly what happened and how it happened. So it might lead you to say, oh, I better buy into this stock because of the fact that it's higher. It's $4. It's probably going to go higher. Really, there was just a split that happened. The company didn't gain any value at all, or the shares didn't gain any value at all. It basically just made it look better for you. Again, when it comes to the regular split, if your shares are $400 and you split it and now they're $100 a piece, then now it looks more attractive as well to a shareholder who doesn't necessarily understand the split. So hopefully this video will give you a better understanding of a stock split and also a reverse stock split. As long as you understand that this doesn't give you any more value than what you had before, or it doesn't make your shares any less valuable than what they were before. It basically makes the stock price look different, makes the stock price look better. If you can understand that aspect of it, then you got what you need to get out of this video, and you know what you need to know about stock splits and reverse stock splits. The stock could go up on a stock split because of the fact that you have companies and you have all of these funds that know that there are investors out there that don't necessarily know exactly what the stock split means and what it is. So when people see that cheaper price, they're just going to rush and go buy in. You got FOMO working, which is fear of missing out. That's what FOMO is. Fear of missing out. So they feel like the stock is cheaper, they buy in, and then the stock price goes up because they're buying. It doesn't mean that the company did anything fundamentally that was better. It could have been nothing that happened at all, but the stock split, and people will kind of rush into the stock. Case in point, when you look at Tesla, you look at Apple, they announced their stock splits here recently, and people have just been buying in, thinking that they're going to get more value when the split actually happens. But you're really not. Your stock prices are just going to look a little bit better to you. So you all keep that in mind. Again, I'm not a financial advisor. I am here to entertain, inform, educate you. And that's what I am trying to do for you. So thank y'all for coming in. I hope you got a better understanding of this. Be sure and smash the like button. Also subscribe to the channel if you like the content, and hit that notification bell over there. It will let you know when I put a new video out, and you can kind of check it out. Thank y'all for coming in today, and y'all have a good rest of the day. Bye-bye.